So when we deal with property management, one of the most important things for us about property management is calculating a property management fee. How much we're going to be paid on any given transaction. And to do that, we have to know this particular math formula. And this math formula is probably going to be the most important single formula that you use in the entire class, because we're going to use it several times for several different types of math the rest of the way. And there is no working around having to memorize it. You absolutely must memorize every word that is on this slide. Because when you get on a test, they could give you any of these labels and you won't know where you are. I've had people say, oh, I just know I figure how many units there are and then I subtract everything out. That will not work, because they don't always start you at the same place. And you're not always going to the same final answer. So you have to memorize phrases like gross potential income. Now, I've given you what that is in a more real world definition there. What does it say that the gross potential income is? Maximum rent that what? You could possibly collect with no vacancy and everybody paying. So when you're managing a property, if every single unit was occupied and every tenant was paying and paying on time, that is your potential income. Why do we say gross potential? Gross because we haven't deducted what yet? Expenses, right? We haven't deducted expenses yet, so it's gross, and it's potential because it's pie in the sky. It doesn't happen. We very rarely realize our gross potential income, because what do we usually have at least some of? Either vacancy or what we call collection losses, which is a really fancy way of saying people who didn't do what? Pay their rent. So we start with this gross potential income. Maximum we could hope to get. And then we subtract out our vacancy and collection losses. And that leaves us with something called the gross effective income, or effective gross income. I've seen it stated both ways. Gross effective or effective gross. This is the rent that we actually do collect. Because if you think about it, maximum rent we could possibly collect, subtract the rent that we don't collect, it leaves us with rent that we did what? Collect. This number is really important to us as property managers, because this is the number that our fee is based off of. If you think about it, is it likely that a landlord is going to pay you based on the rent you could possibly collect or on the rent you actually collected? Which is much more likely? Rent we actually collected. And that's exactly what we see here, that we're going to be paid based on the rent that we actually do collect, not the rent that we possibly could collect. All right? So that's our effective gross income. Why did I say it was important? What's the only thing that we're going to get from this number? That is the rent we collected, but what do we use this number as a basis for? The property management fee. This is where we calculate the property management fee. Write that in your notes. Put that in your notes. The property management fee comes from this number. So if they say we're charging a 10% property management fee, it is 10% of that gross effective income. Is everybody okay on that? Now, the gross effective income minus our operating expenses. And notice the management fee is an operating expense. Okay? It is an expense, but we calculate it based on this number up here. Now once we've calculated it, we just put it in the bucket with all the other operating expenses. So, examples of operating expenses: property taxes. That's an operating expense. The property management fee is an operating expense. Maintenance on the property, any salaries that we have to pay, utilities that we pay, marketing expenses for the property. All of those are operating expenses. And then we get to a really important number. The net operating income. This is the amount of money that property produces. The net operating income on the property is the amount of money that that property produces. So if I bought this property, this is the amount of money I could expect to make annually, because everything in this formula is an annual number. This is the amount of money I could expect to make annually as a result of owning this property. So do you think that's an important number when I'm considering how much to invest in a particular piece of property? If I'm looking at buying commercial property, investment property, I want to know its net operating income, because that's going to tell me what I'm willing to pay for it. Because what I'm willing to pay for it's not going to be based on how pretty I think it is. It's going to be based on what? How much money it's going to make me on an annual basis. Everybody good with that? So then why does it keep going? Well, it keeps going because sometimes we have an additional expense. Sometimes we don't have enough money to pay cash for that purchase. We had to borrow some money. Notice what I did not take into account up here as an operating expenses. What's not there? The loan amount. We call it debt service. Debt service is the payment on a mortgage. And it comes out down here at the bottom. So our net operating income minus our debt service gives us what we call before tax cash flow. Now, if I paid cash for the property, what do you think the numbers are going to look like here on the NOI line versus here on the before tax cash flow line? They're going to be the same number. If I pay cash for the property, here and here are the same number. They're only different if I have a mortgage on the property. Does everybody see that? Okay. So this is the profit produced by the property. This is what the owner actually puts in their pocket after they've paid their mortgage expenses. Okay? Before tax cash flow. Did you say why is it called that, or? Before tax cash flow refers to income taxes. The taxes that are up here are property taxes. So that's a good question. The before tax cash flow refers to before you pay income taxes. Because anything that comes out the bottom of this formula down here is income. If you own this property, anything that shoots out the bottom down there is income. Yes?
This may just be a dumb question, but I guess, so why is this calculated on an annual basis when you're not really sure how much vacancy you'll have or how much rent won't be paid over a year span? Because I mean, like, people's leases end and start in, you know, all different months.
Right. Well, because mostly this formula is utilized in commercial properties. So there's a lot less variance in commercial properties than there is in residentials. Yes, leases stop and start all the time, but remember the vast majority of commercial leases are going to be of long-term variety. 7 years, 10 years, 15 years. And so this is all for commercial. This is all for commercial property. These are investment type properties that you're looking at with this formula. And so their expenses, their income is much more predictable year after year.
That makes sense now.
Okay? Is everybody good with this? And just to give you an idea of how much we're going to use this formula, when we get to the valuation chapter and we start trying to predict the value of a commercial property, of an income producing property, we use its net operating income as the basis for its value. So we're going to have to use this formula to get to that. If we look at return on investment, we use the before tax cash flow to calculate return on investment. So this is a formula that we revisit over and over and over. Pretty much anytime we're talking about an income producing property, we come right back to this formula. So that's why I wanted to introduce it early enough so that you guys have an opportunity to interact with it. Okay? So let's take a look at then the sheet here that I handed out, and let's do some work on these. You have to go grab it off the printer, the one that we're working on now, because I don't think you need this one and you need this one, but the other one is laying on the printer. You know where the printer is? Around the corner?
Yeah, I do.
Yep, just go grab it. Okay. So number 1 says calculate the gross potential income for a property with 18 commercial units that each rent for $1,250 a month. Calculate the gross potential income for a property with 18 commercial units that each rent for $1,250 per month. So, if we do that, how are we going to calculate gross potential income? It's the maximum rent that we could collect if everything was full and everybody was paying, correct? So, what do? $1,250 per month times 18 units times 12 months, or times 12 months times 18 units. Either way, we got to multiply by both. It doesn't matter what order we go in. So $1,250 times 18 units, that is $22,500 a month times 12 months. Equals $270,000. Is everybody okay with that for a gross potential income on that property? All right, number 2 says calculate the effective gross income of the above property. Yeah, it is. Did you get one?
Yeah.
You get yourself one? Okay. Calculate the effective gross income of the property if 15% of the potential rent is not collected due to vacancy or non-payment. So we're going to take that $270,000, and if we wanted to calculate our vacancy, we could multiply times 15%, and times 15% is $40,500 in vacancy. And they want to know our effective gross income, so it would be $270 minus $40,500. $229,500. Is everybody okay with that? Or you could subtract 15%. Absolutely, if you just want to say minus 15%, that's fine. I just show it this way in case they ask you what the vacancy actually is, so you can put a number on it. You know, because in this case, the vacancy is the $40,500, which leaves us with an effective gross income of $229,500. And number 3 is just building on it. And in case you haven't noticed a trend here, folks, I tend to ask you these questions and progressions when I introduce these topics, because guess what? The question would actually be what's here in number 3. It would all be in one. They wouldn't ask you in succession like this, what's the gross potential income, what's the gross effective income, and then what's the property management fee. They would simply say, what's the property management fee of this property, knowing that you've got to go through all those steps. I'm just showing you it broken down into the pieces so you can see how to get there. Number 3, calculate the annual property management fee for the property in questions 1 and 2, assuming the brokerage handling the property management account is charging a 10% management fee. Well, it's 10% of what number? The effective gross income, so that's $229,500 times 10%. Our management fee is $22,950 per year on that property. Everybody okay on how we got there? So this kind of gives you a roadmap. If you get a question where they want you to calculate the property management fee, you should see these are the steps I need to go through. I have to first get to gross potential, and then I have to calculate my vacancy so I can subtract it out, get my gross effective, and from there I'm ready to calculate my property management fee. So let's go ahead and see if you can do that. Do number 4. gotta go grab my calculator. I hate using my phone. Is that an extra one? Nice. Chris has got, she got 12 over here. She's got one in every highlighter color. What you doing? Okay. So that's rent per what? What'd you calculate there?
What, right here?
What's that number? Rent per what?
Per
Per
unit?
unit?
No.
$800 monthly
Yeah.
times 20 units. So that's rent per what?
Month.
Okay. And then what do you need to do? All these numbers in this formula are what? Are they monthly numbers? What do we do up here?
Times 2, times 12.
Why do we multiply it times 12?
Because it's monthly.
And you need to convert it to what?
I got it.
You need to convert it to annual, right?
Yep.
Okay. Okay. So that's your gross potential income. Okay. So what's the next thing you're going to need to do? What's the formula say is after gross potential income? Times 12, 192. Minus. That looks right. Yes. Good. Good. Doing okay? Looks right. How you doing?
It's the bottom.
Good. What'd you forget? What kind of rent is that? How often is that rent paid?
Monthly,
And all these numbers are what?
annually.
Okay. So how do you fix that?
I gotta go back.
No, you don't have to go back. It's going to be the same number times 12 all the way across, right?
Yeah.
So you can just multiply that final number times 12. It'll be the same thing.
Thank you.
But if I were you, I'd go back and fix all those numbers so that you see what you need to do. Remember, they're all monthly. Yes. Good. How you doing? Don't forget to take it out to annually. You're working with monthly numbers. Good. What you got? Good. Good. What you got? Good. Good. All right, most of you look like you're on the right path here. So let's quickly run through the steps. We've got 20 units that rent for $800 per month. Well, that's already a problem, right? Because per month, what do all these numbers need to be? They need to be annual numbers. So we can go ahead and get that to annually. 800 times 12 is $9,600 a year. And how many units do we have doing that? Times 20. And it doesn't matter if you do times 20 and then times 12 or times 12 and then times 20. It works the same either way. So I have $192,000 for my gross potential income. Then what do I need to do? I need to subtract out, so minus 10% vacancy. So if I do 192,000 times 10%, I'm going to come up with $19,200 in vacancy. So that's minus 19,200, which gives me 172,800 for my gross effective income, right? And then they told me that we were charging an 8% management fee, so 172,800 times 8% equals $13,824. Okay? $13,824. Here's the thing, folks. Do not, unless you want to see Travis get really frustrated with you doing math, because there's very few things I get frustrated with you about math, because I understand it's complicated for a lot of folks. Don't sit there and stare at a blank piece of paper, because writing a formula down has nothing to do with math. It has to do with you being lazy and stubborn. And if you're stumped, and I walk up there and I look and you haven't even bothered to write the formula down, that means you're not even trying. You're shutting down. You're going, I can't do this. That's what a 3-year-old does when you're trying to teach them how to tie their shoes. Have you ever been able to successfully teach a child to tie their shoes without them actually trying to tie their shoes? And you never will. So the one thing you can all do, and I'm not being critical here, I'm just trying to really make a vivid point. You can write the formula down, because sometimes just the act of writing the formula down, you'll be like, okay, well, I know at least what that is. And you start to fill in the blocks a little bit, okay? All right, so $13,824. Now, number 5 takes it a step further. It says calculate the net operating income of a triplex property that's fully rented, with each of the units generating a $750 monthly rental rate and a 10% annual collection loss that's managed by a broker property manager who charges a 10% management fee. This property has annual repair costs of $800 per unit, and the annual property taxes on the triplex of $5,600. So what are they asking us for? Calculate the what? Net operating income. So again, first thing I would do here is write down what I actually need to be doing. I always start at gross potential income. My gross potential income minus my vacancy and losses.
Does that mean, just real quick, does that mean that 10% of the people aren't paying?
10% of the people aren't paying. For whatever reason, they haven't collected 10% of the rent. So gross potential income minus vacancy or losses equals gross effective income. And gross effective income minus operating expenses equals NOI. That's what I mean about writing the formula down. Just write it. Just give yourself some sort of a starting point. Because now at the very minimum you see, well, I have to start with what? Gross potential. And if you go back and look and see what gross potential is, okay, well, that's the maximum amount I could collect if everybody was paying. So what I need to know then is how many units and how much do they pay. So how many units do we have here? 3 of them. So we got 3 units that are renting for $750 a month times 12 months a year. So 3 times 750 times 12, I got gross potential income of $27,000. Does everybody agree with that? And now I need to subtract my vacancy and losses. Well, it says they're fully rented. That's good. But it did say we have a 10% annual collection loss. So I need to subtract 10% of that $27,000. So if I punch that into my calculator, I get $2,700. So I'm subtracting $2,700 in vacancy. Is everybody good with that? And then they say we're charging a 10% management fee. So I can go ahead and calculate my gross effective income here. That's $24,300 for gross effective income. Now I need to start subtracting my operating expenses. Well, the first operating expense that I always recommend you do first, think of yourself first, is the management fee. That's the first one that's the one we care the most about, right? I want to get paid. So the management fee is how much? 10% of the gross effective income. So 10% of that, $24,300. So we've got a management fee of $2,430 plus repair costs of $800 per unit. And how many units do we have? Three. So that's 800 times 3 is $2,400 in repairs, plus property taxes of $5,600. So we're subtracting out all that stuff added together. If we add together the $2,430 management fee plus $2,400 in repairs plus $5,600, that's $10,000. So minus $10,430 in operating expenses. So $24,300 in gross effective income minus $10,430 in operating expenses is going to give me an NOI of $13,870. Is that making sense for everybody? It's all about breaking this down into small, digestible pieces, right? Because when you look at one of these questions, it can be overwhelming because you get so much stuff. But if you can break it down into small pieces, I think you can deal with it. All right, work on number 6, and I'll walk around and take a look. Yeah, well, you can, if you want to, you can go ahead, but I'm going to take a look at. Now, why would you multiply that times 12?
This month is annually.
Okay. Mm-hmm. Doing okay? Mm-hmm.
Take that times 12.
Everything's annually. Pay attention to those words annually and monthly. Okay.
Just keep following.
That's a vacancy, gross effective. You got more expenses than that.
Do I? I didn't. do
No,
this.
but where's the rest of your operating expenses include your management fee, they include your taxes, all of that is, so this 49.24.
Oh, that's how I added them.
Right.
That's what I did wrong. I did add them.
Yep. You got to add all this. Yep. Mm-mm.
Oh, per month.
Mm-hmm. Yes. How you doing? Okay, that's good. That's good. Okay, so you're going to subtract all of this now, right, to get to your,
Right.
Okay.
I'm gonna add these two and then
So-
subtract it out.
add all three of those together and then subtract it out. That'll be your net. Good. Good. You're on the right track. How you doing?
I could have stopped.
Okay, so tell me where you stopped.
Well, I just don't know what my next step is because.
Okay, so this is your gross potential, and this is your vacancy and losses. So, what did you do that math
I took 10% of that.
for? What?
Oh, wait a minute. That's not.
You never gave me gross effective income.
So I have to subtract that from that.
Right, and give me gross effective income.
Okay.
Remember, your property management fee is calculated based on gross effective. Okay, you getting there now? Gross effective. That's good. You're, you got the answer. You got the answer right.
You're either wrong or I'm wrong. One of the two. I know what you did.
Where did I go wrong at?
That number's good. Well, no. You're off by a factor of 10 somewhere.
He's looking at the before tax cash flow. That's what you calculated, I think.
All right. So this is gross. This is gross effective. That's your property management fee. Yeah, you don't need to do anything with this.
Okay.
That's
But
what
you're also wrong in here somewhere because you haven't taken into account the maintenance at all. The monthly maintenance fees, you haven't done anything with it. You need to start grouping your operating expenses together rather than trying to subtract them out one at a time. That's right.
It's a common
No.
mistake, must be.
Did you do something with that?
And that's probably where he's coming in.
Well, you weren't supposed to do anything with it. Debt service is not part of this equation. Look at the equation again. Look at the formula again.
Because you look at the formula,
Debt service is after NOI. Good. No. I didn't see it. No.
I think that's why I live on.
Why not?
I don't know. That's what I'm trying to see.
Because
Where
we don't
is
have to
your-
take into consideration this.
No, that's right.
Okay.
Oh. All right. Because you calculated your property management fee on your gross potential, not your gross effective. Property management fee's off. You calculate the property management fee after you have subtracted out your vacancy, not before. All right, so let's look at this thing. I didn't have to calculate gross potential income. They gave it to me. So you all got that far. You did good on that one. $487,000. First thing the formula says I'm supposed to do is subtract my vacancy. And in this case, my vacancy was $64.80, but $64.80 what? Monthly. So if you multiply that out times 12, you ended up with vacancy of $77,760. So once I subtract out my vacancy, I'm left with a gross effective income of $409,240. Why is that number important? Why do I have to get to $409,240? Because my management fee is based on that number. You cannot possibly answer this question without calculating that gross effective income first, because you can't get your management fee without it. Remember, we don't pay a management fee based on the amount of rent we possibly could have collected. We pay a management fee based on the amount of rent that was collected. So in this case, we collected $409,240 in rent. So if you look over there on the right, I've calculated the property management fee. 10% of $409,240 is a $40,924 property management fee. You see what I mean now? Okay. Is everybody good with that? Now that just becomes one of my operating expenses. I see a lot of you subtracting that out separately, and that's okay as long as you don't forget the rest of the operating expenses. Remember, it wasn't just that $40,924 management fee. We also had $43,000 in maintenance. And where did that come from? Well, they told me that we had $3,660, or $3,600, I'm sorry, $3,600 in monthly maintenance fees. What's the problem with that? It's monthly, and when we multiply that out times 12, we get $43,200 in annual maintenance. So that's where this $43,200 comes from here. And then finally, the other $38,950 that they gave us in operating expenses. So all of those operating expenses have to come out, and once you subtract all of them, you're left with $286,166 in NOI. Now, several of you went too far. You subtracted out $21,500 in monthly mortgage payments, which if you had done that, you would have come up with $28,166. What is that? If you went that far, that's not net operating income. That is what? That is before tax cash flow. Do you think that would be an answer choice on the exam? Yes, absolutely. Remember that debt service, mortgage payment comes out after you get to NOI, not before, but after. Okay? Number 7 lets you go just as far as you want to go. Go for it. Calculate the before tax cash flow of a 100-unit apartment building. Good. Good. What you got? Good. 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 Now where'd this number come from? No. Gross effective income. Why'd you label it gross potential income? No, sir. first of all, gross effective income was $370,000 monthly. Well, then third time was the charm.
Yeah, I'm not there 3 times. I'm lost.
Why are you lost?
I'm gonna be found.
If you would write the formula down, you wouldn't be nearly as lost. Mm-hmm. They're separate. They're separate. Good. These are big numbers. Don't let them intimidate you. 12 is good. Okay. You left out the property management fee. Remember, property management fee is a operating expense. Okay. So why would you subtract vacancy out of gross effective income? But what does vacancy get subtracted from? Gross effective income. Guess where you are? You're already past vacancy. So what do you need to do with the vacancy? Disregard it. That's exactly right, because it's already been factored in to what they gave you. Good. How you doing? Okay, so that's gross effective income. What's this?
I need to take minus this from
This
this.
is the fee.
You sure that number's right?
We need to go
I'm gonna check it. I'm gonna go back and check it.
'Cause I think you did it on the monthly amount or something. All right. Let me turn them projectors back on and we'll go through it. So on this one, they gave you information you did not need. 100 units, what do we need to do with it? Nothing. Vacancy, what do we need to do with it? Nothing. And why is that? Because they gave us the gross effective income. And this is a matter of looking at the formula and understanding they already started you past that point, right? And if you go back and look at the formula, I need vacancy and collection to get to gross effective. But if they've already given me gross effective, I'm there. It's just junk information. Not necessary. So all I had to do to start was write down my gross effective. $370,000 a month times 12 months. So I come up with the gross effective annual income of $4.44 million, $4,444,000. Everybody okay on that number? That's my gross effective annual income. Now, I do need to start subtracting out my operating expenses. The first of those operating expenses is a 9% property management fee. So I calculated that out, and remember, it's 9% of gross effective income. So I calculated that out at $399,600. $399,600 for my annual property management fee. I could probably live off of that as a property management fee. Okay. I also had another $72,000 in operating expenses, which I'm going to subtract out as well, and that gives me a net operating income of $3,968,400. But they didn't ask me for NOI, they asked me for before tax cash flow. So I mean, now I do need to take that extra step, go one step further, and get to before tax cash flow by subtracting out my annual debt service. And they gave me a monthly debt service payment of $12,890. So multiply that out times 12, it's $154,680. And when I subtract that out, I end up with a before tax cash flow of $3,813,720. Okay? Don't let big numbers intimidate you. They're just numbers with more zeros, that's all. For residential, this is commercial. Really, we don't generally think of residential property as being income producing. This is for income producing properties. Yeah.
Before you do anything, just convert everything annually.
Mm-hmm. No, because everything needs to be annual in this thing. So if anywhere you see monthly, you could just go ahead and multiply that by 12 and you'd be fine. Because you do need to take everything to annual in this formula.
Do they just like settle up at the end of the year? The property, like the fee is based on, you know, is there like how, if you like go into an agreement, I want you to be my property manager.
Mm-hmm.
Commercial property, how do they establish? They just establish the rate, but then the end of it, like things fluctuate throughout the year.
Right, so usually it's paid monthly. It's usually paid monthly. So this, when you look at this sort of a budgetary thing, it's usually reconciled monthly as far as the property management fee goes. And then, of course, when you get to the end of the year, when all the final numbers are in, there might be a bigger or larger or smaller payment depending on, you know, what they need to do to reconcile. Mm-hmm.
Is operating expense, does operating expenses include management fee already?
I should clarify in this question. I need to go in there and say other operating expenses that total $72,000, because normally if it says total operating expenses, that would include the property management fee.
That's why I didn't
Right,
mind it.
right, yeah. So I need to change that on this sheet to say other operating expenses so that's clear. But generally speaking, yes, the operating expenses would include the property management fee because it is an operating expense. Okay? How y'all feel on this? Okay? I wanted to introduce it early because you're going to see it a lot. You're going to see it several times throughout the rest of the class. Now you can turn to chapter 12 in your book. And the good news is, now that we've gotten the math out of the way in this chapter, the chapter itself is fairly short. It's page 356 in your book. So property management, the first thing you need to know about it in North Carolina is that this is the very first thing we talk about that provisional brokers are not allowed to do. Provisional brokers can practice almost any type of real estate brokerage in North Carolina, but here's number one that they can't do. As a provisional broker, you're not allowed to be a property manager. This is for non-provisional brokers. Property management is a function of a non-provisional broker. Okay? There is one exception to the rule of who needs to be licensed, and that is if you're the employee, so W-2 employee, of the corporation that owns the property. Then you don't need you don't need to be a broker in order to be the property manager. So this is generally, we call it the apartment complex exception. If you are a salaried employee of the apartment complex, you can be the property manager and not have a real estate license. Is everybody okay on that exception? Other than that, if you're managing property for somebody other than yourself and for a fee, you need a license to do it. That's the only exception. So what did I say the exception was? Because they're going to test you on the exceptions. They don't test you on the rule. They test you on the exception. If you're a W-2 employee of the owner of the property, that's the exception. And it's the only one. So what is the function of a property manager? A property manager is somebody who preserves the value of a property while generating income for the property owner. What comes first in that definition? Preserving value. So the most important function of a property manager is actually to preserve the value of the property. Secondary to that is to generate income and to follow the wishes of the property owner. But the primary goal is always to preserve the value of the property. It is an agency relationship. Property management is an agency function. This is an agency relationship. And in fact, and I would point this out to put in your notes, this is going to be asked, this is the only time as a real estate broker we function as a general agent. In sales transactions, how do we function? Special. Special agents have what kind of authority? None. General agents have decision-making authority. What kind of decisions can a property manager make? Rent prices, who to lease to, accepting tenants, when to evict tenants. Basically, can the property manager sign in the place of the property owner on any document relating to that property? Yes. That's why they are a general agent. So let's talk about some things that the property management agreement is usually going to call for or have in it. A description of the property. Some kind of time period. But by time period here, I want you to put can automatically renew. That's very different than a listing agreement or a buyer agency agreement. Property management agreements can automatically renew in North Carolina. And the reason for that is we want to protect the tenants. Think of who relies most on the property manager. It's not the landlord. Who relies most on the property manager? The tenants. That's where they pay their rent. That's who they call when they have a problem. We don't want that to just expire and them have nowhere to go. So we say that property management agreements can automatically renew. The property management agreement should say what the manager's responsibilities are, what they're responsible for. The property management agreement should say how often the manager is going to report back to the landlord. Do they want monthly reporting? Do they want quarterly reporting? Do they want annual reporting? Property management agreement should say. It should say how we're going to get paid. What's the basis for our commission? All those things should be in there. And then what the owner is responsible for and what happens when we terminate this thing. Those are all things that should be in that property management agreement. This is definitely a test point. A property management agreement is not a listing agreement. Just because you've been hired as the property manager doesn't mean you've also been hired to list the property for sale. Can the owner employ two different firms, one to manage the property and a different firm to list the property for sale? Absolutely. Don't assume that because you've been hired as the property manager, you're also going to be the listing broker. That happens a lot, by the way, with people who are buying and selling houses too. You'll have the person list somebody's house for sale and they just automatically assume that that person's also going to use them to help them buy their new house. Do they have to? No, it's two separate functions. We talked about the property management fee. It's usually a percentage of collected rent. Usually a percentage of collected rent. Now, when we talk about residential property management, it's usually just a percentage of the gross rent that we collect every month, and it's done on a monthly basis. On a big commercial property, it might get a little more involved. But for residential property, it's usually just some fixed percentage of the rent that we collect every month. And the beautiful thing about a property management fee is, who's collecting the rent? Who do you think is collecting the rent? The property manager. And where are we putting that rent? In a trust. Whose trust account? Our trust account. Is it hard to collect our property management fee? No, because we get the money first. You can bet I'm going to get paid, because the landlord's waiting for me to pay them their rent. And guess what I'm deducting before I write that check to them every month? My property management fee. See, somebody always used to say, they never could understand why I would always say 1 check in and 2 checks out. That was how I told people to manage their trust accounts when it came to property management. 1 check in and 2 checks out. 1 check in is the rent check. What's 2 checks out? 1 to me and 1 to the owner. That's exactly right. Because I separated out my fee before I paid. Don't pay the owner the whole rent and then expect them to pay you. That's stupid, right? Deduct your fee from it before you send it to them. Duties of the property manager. Follow the owner's objectives. If the owner gives you a goal of how much money they'd like to see the property produce, you should try. Obviously, that may not always be possible. You don't want to sacrifice maintenance of the property, though, just to satisfy the owner's goals. If you ever have an owner who really wants you to manage the property in such a way that it's going to diminish the value of the property, you should probably consider giving up that account. Coming up with a management plan, coming up with rents for the property, doing a market analysis so you know what you should be charging for rent. Those are all responsibilities of the property owner. I mean, the property manager, sorry. Create a budget for the property. What kinds of things will go into that budget? Maintenance. How much I estimate I'm going to have to spend on maintenance. What else? What are some things that are directly within my control as a property manager? Marketing the property. Am I going to spend $10,000 or $20,000 or $2,000 on marketing the property? What else? Salaries. How many people am I going to hire to help staff the property? Of course. What kind of amenities are we going to offer? And then, of course, the one thing that affects the budget the biggest is at the top of the budget, which is the amount of rent collected. Remember, I'm the one setting the rental amounts. And just as something to mention here, when you talk about setting rental amounts, especially if you're managing a large property, your goal should not be 100% occupancy. That's actually a poor way to manage a property. Because if I get to 100% occupancy, guess what I'm doing wrong? I'm not charging enough rent. If I'm at 100% occupancy, now, if we're talking about 5 units, obviously we want to be at 100% occupancy because even one being vacant is a tremendous drop in our revenue. But if I've got 100 units, I don't want 100 rented, maybe 95. Because are we always going to have turnover in a property that big? Right. So ideally, if I can have 95 rented at $1,100 a month, I'd rather have that than 100 rented at $1,000 a month. Because if I've got 5 vacant units and somebody comes in and needs a unit, don't I have one to give them? And then when somebody else is going out, I don't have any drop in occupancy because I've got extra units available to keep that flow moving. Does that make sense for everybody? So really, realistically, 100% occupancy is not a good target for a big property. Okay? Obviously, budgeting, we got a lot of fixed expenses like property taxes, and then we have expenses that are not fixed. We also talk about things called capital improvements. A capital improvement is not generally going to be the responsibility of the property manager. A capital improvement is something new. We're replacing something, you know, we're rebuilding something, we're adding something in, like a new pool. That's generally going to be the property owner's call. Okay? Is everybody good on these items? Like I said, the chapter's pretty short after you get past the math. Renting the property, we don't want to have high vacancy, but we also don't want to have no vacancy. We always want to look at local rates and set them appropriately. As far as selecting the tenant, we're going to talk a lot about this in the fair housing chapter. If you are renting a residential property, selecting the tenants is going to be very limited in what you can do based on the fair housing laws. Now, if you're selecting a commercial tenant, then you have pretty much the freedom to choose the tenant on a number of factors. But on a residential side, their ability to pay is about all that you can use as a criteria, and their rental history. Functions: collect rent, perform any of the landlord's duties. So on a test, if you see, for example, you know, filing court actions for eviction, would that be the duty of the property manager, you think? Yeah. Anything that's normally the landlord's duty would be the duty of the property manager. Over on, let's give you a page number here. Page 371, 372, we get into maintenance of the property. And you should know the difference between preventative and corrective maintenance. What do you think preventative maintenance is? Air filters. You're doing maintenance to what? Prevent things from breaking. What's corrective maintenance? Fixing things that are broken. Which one is more cost effective in the long run? Preventative maintenance is far more cost effective. Corrective is more costly, right? So as a property manager, that's why we say protecting the value of the property. That's our number one function. So preventative maintenance, like things like changing air filters, is a huge piece of preventative maintenance, because number one expenses when you have a large property is HVAC, and one of the biggest ways to prevent those issues is just changing the filters. So that, you know, that kind of maintenance. Just so you know the difference between those, you're in good shape. Okay? We don't need to talk about that. Obviously, the property manager should be knowledgeable about what they're doing and have a good knowledge base of the area in which they're renting, whether it's commercial, whether it's residential, whatever kind of property you're renting, have a good knowledge base of what's going on and the ability to respond to problems. Now, if you are indeed renting property that's in a commercial setting or a public setting, non-residential, you have to comply with the Americans with Disabilities Act, the ADA. The ADA, which is on page 373 in your text, applies to any place of public accommodation. Now, you don't need to understand what all the ADA rules are. You just need to know that the Americans with Disabilities Act applies to places of public accommodation, not to residential properties, for example. Residential properties are governed by the Fair Housing Act, which is a whole other chapter that we're going to talk about separately. Now, if you have the pleasure of managing something like an apartment complex, guess which one of these laws you get to apply, you get to play around with? Both of them. Because the public areas, the offices, the parking lots, the hallways, those are under the supervision of the Americans with Disabilities Act. The units themselves are under the supervision of the Fair Housing Act. So if you're managing that kind of property, you get to deal with both. If you're managing strictly a public property, like this building, for example, the ADA would be in effect. And there are lots of differences that come along with that. I mean, even with animals, for example. The ADA has different rules for service animals than the fair housing statutes do. Does anybody know what the defined service animals are under the ADA? Because there's a definition with the ADA. No, that's not the definition under the ADA. Dogs and miniature horses. Dogs and miniature horses are the defined. That's what I said. No. Dogs and miniature horses. So, here's what that means. It has to be a dog or a miniature horse. I don't care what their function is. If it's something other than those two, they're not allowed on a place of public accommodation. In other words, in a store, can you have a service cat? No, that is not a protected animal under the ADA. But guess what? You could have a miniature horse. There's a lady in Chapel Hill who has one. It's awesome. He has shoes. It's the greatest thing I've ever seen. He has his own little tennis shoes he wears around. And I'll tell you why miniature horses get the specific exemption. Because they're great vision assistance animals, and they live about 4 times as long as the average dog. So people only have to learn 2 or 3 animals their whole lifetime versus 7 or 8 if they have dogs, for example. But the lady in Chapel Hill, she's blind, and she has her little miniature horse, and the van takes her around everywhere, and the horse sits in the front seat of the van. It's the funniest thing you've ever seen. You see him sitting up in the front seat. But that's different in fair housing. Fair housing does not define species. Fair housing says any animal that performs a service. So if you're renting apartments, for example, and somebody has a service snake, you have to allow it. Is that a real thing? According to the fair housing statute, it is. Because the only 2 questions I am permitted to ask as a residential property manager: do you have a disability? That's what I ask the tenant. Do you have a disability? And if they answer yes to that question, then I ask the second question. If no, I cannot ask what it is. Definitely cannot ask that question. The second question is the animal trained to assist you with that disability? Those are the only 2 legally permissible questions. And if the person answers yes to both of those questions, that is an allowed service animal. And I cannot say no to it.
So you telling me a snake can be a service animal?
I'm telling you that according to you asking my personal opinion, and you asking me what the law says.
So I can go
My
right
personal
now and say
opinion is something that doesn't have shoulders can't help you with anything. So,
right
you know.
now I have a disability, and I can say my alligator is my service animal.
At your house, but not in this room, because in this room we're governed by the ADA. And the ADA says you can have a dog or a miniature horse. Yeah. But this creates, listen, this is a huge bone of contention if you're doing residential property management. Because is it likely that your owners are going to say no pets, right? Guess what? A service animal is not a pet. A service animal you treat just like a person. They can't say no. They cannot charge you a pet fee. It's not a pet. It's not a pet. You cannot ask them for verification. That is correct.
I wish I would have known that a long time.
I am telling you, that's what the law says.
I got an alligator, and they was in my yard. They said that I couldn't have it.
That was your service animal. That's exactly right. Okay? Yes. No, you cannot charge a fee. No, if they damage something, of course, because if a person damages something, you can charge a fee for that. So you treat them just like a person. That's the best rule of thumb. If you remember, a service animal, you treat it like a person. Okay? They act too much like people for me. I just, it's like, that's too smart for me. My dogs are too smart for me. I definitely cannot deal with a primate of any kind. So, okay. But that's the ADA. So the ADA deals with places of public accommodation, whereas the fair housing statutes, which we'll talk about later, deal with private residences. Okay. Over on page 375, it brings up the idea of risk and how you transfer risk as a property manager. Well, as a property manager, you transfer risk the same way anybody transfers risk, and that's with insurance. You try to avoid risk, you try to minimize risk as much as you can, but ultimately you can't completely avoid it, so we transfer it. And the best way to transfer risk is through insurance. You buy insurance to transfer risk. That's what you do. Another way to think of it is your deductible is the amount of risk that you don't transfer. If you wreck your car and you have a $500 deductible, your risk is $500. That's the risk you could not transfer. The rest of the risk goes to the insurance company. Okay? That is it for property management.
Travis,
Yes?
in the beginning, you said that about the exception, W-2 employee of the owner of the property. So you're saying provisional broker cannot do property management, right?
Correct.
But the exception is a
I'm
W-2
saying
employee.
anybody can be the W-2 employee of the property owner. They can be unlicensed, provisional broker, it doesn't matter because the brokerage rules don't apply when you're a W-2 employee of the property owner. Okay, so that's a good question. So yes, a provisional broker could do property management, but they would be doing it under that exception. And their provisional status wouldn't help them at all because an unlicensed person could do that. Okay, the only person who can do it without being the W-2 employee of the owner is a full broker, non-provisional. All right, let's, oh, do you have a question, sir?
Yeah.
Go ahead.
Sorry. Can you just like explain the difference between a landlord and a property manager? I guess I'm kind of just trying to figure out like how I can break the two in my mind.
Well, the landlord is the owner of the property.
Okay.
So they're the ones that own the property. The property manager is a broker who's been hired to perform the legal functions of the landlord. In the eyes of the law, they are the same person. Like, you hire a broker property manager to do your job as a landlord. Whereas the landlord is the person that actually owns the property.
So their job, what is their job?
Their job is to collect a check at the end of the month. The landlord, I mean, seriously, if I own the property and I'm hiring a property manager, I'm hiring that property manager so that I don't have to deal with the daily maintenance, the collecting rent. I just want the money. I just want to collect the income.
Choose to not hire that and be that person themselves.
Sure, lots of landlords choose to not hire a property manager. That's exactly right. Okay? But in the eyes of the law, we're the same person. The landlord is the property manager. Which is dangerous in residential property management because if the landlord does something that's a fair housing violation, it's you just committed that fair housing violation. So one of my first rules for property management was always the landlord was never allowed to come in contact with the tenant because I didn't know what they might say or do, and I didn't want to be responsible for it. Okay? Good? All right, let's take a break. Thank you.